The Dow hit a record high.
Holding steady.
The economy.
Oh, we got your back, Jack. Make a great plan, man. A real McCoy, Troy. Our 3 cents for free. The options to pick, Nick. You need to discuss much. You got the key, KC, in exit strategy.
All right, guys, welcome back to another episode of Our 3 Cents. It's a podcast directed at business owners trying to help you be more profitable, but really more mindful of the value that you might achieve from your business if you were to sell or, buyers. Listen up as well, because we can talk to you about ways you could identify businesses that might be available on the market that you could purchase and make more profitable, make you some more money.
That's right. And, as we discussed on episode 1, in general, it's just good business sense that we're talking here.
Yeah. Absolutely. Yeah.
Exit planning. It's just good business strategy.
That's right. Yeah. And it's, topics we might cover is really beyond just purely exit strategy, but it's business valuation, again, ideas for increasing profitability, as you said, Casey. Don't know how you expand much on the note of just good business strategy.
Exactly.
All right, so I'm Troy Harmon, and I'm here with Casey Smith and Nick Antonucci, and guys, we wanted to talk a lot about some exit planning today. What is exit planning? And we really want to aim this more at what we see going on with a certain demographic in the market right now, which is a lot of baby boomers who own a business. They're at a certain age where they're starting to think about their next steps in life, which may not include their business. So
episode 1 was kind of broad topics,
sure,
right, guys?
Yeah.
The overall concept. And now we kind of want to get into what are your strategies to exit your business. That may not be a total exit in some cases. Maybe you want to take some chips off the table.
Yep.
And that's perfectly okay too. It doesn't have to be, at one time stepping away, giving up full ownership or even control, but take some chips off the table. You've grown your business. It's, you know what the value is, and you want to provide some liquidity for yourself.
Yeah, I think that the point of today's episode really is just to try to dive into what are the options that owners have to take some chips off the table, as Nick said. And, 2/3 of business owners from some surveys that we've looked at don't even know what their exit options are, and they don't have an understanding of the different types of exits that could occur or that might be available to them.
Yeah, it's not uncommon for a business owner to also be more of a technician who just really focuses on the service they provide and making sure they take care of their customers and clients. And in the mix, they lose sight of, this is a business and I might not live forever, so I can't really run it forever.
Yeah, we talked last time about the D's, the 5 D's, death, divorce, disability. I always want to say dismemberment. What is it? Disagreement.
Disagreement. Yep. That's
divorce.
A major one.
Did you say divorce?
Divorce, death, disability, disagreement, and I'm drawing a blank on the 5th one. It'll come to me. Go back and listen to the first episode.
That's right.
But it really, when we're talking about exit options, there's really 2 broad categories of exiting a business. You can either exit internally and, give the ownership, somehow transfer the ownership to either family members, employees, management, what have you, or
you say give. Now that's really
I said give, and then I changed it to transfer.
Okay, because I was going to say I don't really run into too many folks that are just willing to give their life's work away.
We've seen it. If we're talking like an intergenerational transfer, we absolutely have seen it, and
that's true.
And not insignificant ownership in the business. It's been large stakes.
There's still an aspect of value even in that, though, because when you gift something to someone,
the tax man wants to get his money.
Every transaction, whether there's a price or not, the tax man wants to get involved, and there is a price.
Yep, absolutely.
Well, I think, guys, if we can just kind of step through some of the options and, discuss what exactly they are, maybe some of the pros and cons to each of them, just to give a general idea of what may fit, a particular situation option versus the other. And there isn't necessarily always a right or wrong. It's dependent on the situation.
Yeah,
you know?
sure. Exactly. What is the owner trying to achieve out of the transfer of value of their business?
Yeah.
Essentially is what it boils down to.
And, dealing, as we just mentioned, dealing with family businesses, a lot of small businesses, there is the desire to pass it on to the next generation, to keep that business within the family. So
I thought you were going to say to choke your partners who are also.
I think that's part of the family business, whether you're in the phase of transitioning or not. I think that just goes hand in hand with family business. And you can speak to that, right, Troy?
Oh, yeah, absolutely. I've actually been in
disagreement for sure.
I've been in business with family, and it didn't really work well for me. I can't even say it. Maybe there's a problem still. Who knows?
Sure.
There's really not. It can make Thanksgiving a bit uncomfortable for a while, but I will assure you that your emotions, no matter who or how you're dealing with other individuals, when you get something of value between you and them, emotions seem to always pop up.
Sure.
Yeah.
Well, go ahead,
Well,
Casey.
we see this, even on the financial planning, the individual personal financial planning side, somebody passes away and they've got assets. There's generally speaking, it's rare that you find no disagreement at all among that. And so when you're talking about a business that has a lot of intangible assets and various things like it becomes all that more complicated.
Right. Yeah.
Sure. Well,
it can be tough.
I think a great jumping off point for the transitioning, to your own children within the family. According to studies, 50% of the typical business owner want to transfer their business to their children, but fewer than 1 in 3 of these owners end up doing so because this plan has a low success rate, generally speaking. But
So you would have to begin grooming family well in advance of any sort of exit.
And a deeper topic for another day, but that exactly what you just said, Troy, that's unfortunately not common. You don't begin grooming a successor early enough, and that's why there's such a low success rate here.
And that would also go for maybe an internal manager that you trust with the daily operations of the business that might not be blood kin.
Extended family is what they call it.
We could probably just end this whole series right now if we could convey it with one message, and that is, I just said, you've got to begin early. If you begin planning early and think about this as a business that may be transitioned into the next stage of your life, we could end the topic and move on, right?
Well, it's just like we said earlier, it's just good business strategy. Start thinking about your exit now because you need that time to start putting these things in place so that you're ready to exit when the time comes. Or if the fifth D, by the way, is distress. That's
distress. Oh, okay. Well, distress.
I knew it would come to me.
You were under distress.
I was under distress, yes.
Yeah, when trying to remember it on the spot.
Exactly.
Well, let's get our hands dirty. Let's talk about the details.
So, benefits are you get to keep the business within the family.
Yeah.
A lot of individuals want to see that legacy continue for years. And not only that, but it provides, the possibility of financial freedom or, financial success for future generations to come within your family.
Legacy.
Exactly. And you can earn an outsized income from in a way that you probably wouldn't be able to do just going and getting your standard job out of college.
Sure.
And then your family can potentially acquire the business for a lower cost, and then you can retain control within the family.
Exactly.
It would be easier for most people to allow for owner financing in that way.
Absolutely.
And then you might have a stream of cash flows into the future that benefit you in retirement too.
Exactly.
To the contrary of that, though, you're not going to get that cash payment in most situations from a family member. They don't have the access to capital that, let's say, if you sold to another competing business or to a private equity, something like that, which we'll get into later. And also, as we said, there's the friction that it can create within the family. Well, you might have 2 children and only one has shown interest in being in the actual family business.
Yeah.
How do you treat that?
The impact of the family dynamics, I think, is the biggest negative potentially to an intergenerational transfer. And it's very hard to do. It's a low rate of success, as we said. So, just depending on the circumstances, this may or may not be a good option for you and your business.
Yeah, well, I would say that if you think before you get into the conversation with your family that the transition will be absolutely smooth and emotionless, I really believe that you're probably deluding yourself.
Yeah.
I don't think
definitely.
that it's going to be that smooth. It happens. Weird things happen, and that would be the one-off, the outlier.
Y'all seen Succession on HBO?
No.
It's great. I mean, if they can make a drama out of it on HBO, then obviously you know what you're getting into.
That's
Nick
right.
and I have done some business valuation engagements.
Yeah.
We don't need to watch the drama.
No,
We've seen it up
absolutely. You guys-
close and personal.
No
That's
doubt.
right. And one last thing, something we've talked about being important is the timing of the exit on your terms, when you want to.
Mm-hmm.
This gives you a little bit of flexibility if it's, a transfer within the family that in most cases you can probably leave when you want to. It's not as if, I transitioned the company to my children and they're kicking me out the door right away. You probably have a bit more flexibility in terms of when you fully step away.
Hopefully, if it's going to be a successful transition, then I would hope you would have some flexibility there where the kids aren't kicking you out the door.
That's right.
Yeah, well, the one thing that you got to be mindful of, though, you want that business to be as healthy as possible when you leave.
Mm-hmm.
I mean, that's a huge time of transition. You've got new management taking over. You would want to make sure that the finances, at very least, are covered as well as possible, right?
Absolutely.
So next, talk about sale to other shareholders. In some cases, you have a business that's solely owned by one individual,
Right.
But more often than not, there's a group of shareholders or several partners, shareholders, and perhaps it's one individual that wants to step away. And a pro there is you have a ready market in which to sell your shares to in most cases.
Good
And
potential
a motivated buyer.
Yeah, exactly. Now, in most cases, and Troy, we've talked about this plenty as it pertains to business valuation, most companies will have a buy-sell agreement in place.
Most.
But
But it might not be the best.
You'd be
Exactly.
surprised how often that's not the case.
It's not
too.
the case, or the terms in which the valuation will be done
Right.
is so off base with reality. So basically what this means is it's an agreement that you can sell your shares to other shareholders in the company, the basis for valuation to do so. And a lot of times we've seen companies that aren't asset heavy businesses that say the company will be valued based on book value. Well, if you're a service company and you don't really hold much in terms of assets, then you're going to get screwed on the valuation.
Yeah, very, very likely. The other thing, Nick, you talk about a buy-sell agreement. I think that's probably a good topic that we could cover for a full, absolutely full segment. But the reality is, if you don't have one, and that's quite often the starting point, if you don't have one, you should probably give one of us a call. The number, 770-429-9166, Henssler Financial. Ask for KC Smith, ask for Nick Antonucci, or ask for Troy Harmon. Any one of us can help you get into the conversation there and what you need to look for, right?
Sure.
So moving on, next topic.
So other internal, exit options would include things like an Esop.
Esop.
And then this is another one we could spend at least one whole
At
show
very least.
on. Very complicated. It can be.
So what is it?
Basically selling
the business.
You're selling the business to the employees effectively, but it's not the employees don't become shareholders necessarily. The shares of the business go into trust for them, and it's essentially an ERISA governed. ERISA is the Employee Retirement Security Act. So like your IRA, your 401k is governed, or your 401k rather, not your IRA, is governed under ERISA. Right. So Department of Labor is involved. Sure. And this is why you've got some issues. So it's a retirement plan basically for employees.
I mean, that's the way it works. A lot of employees might be motivated to work harder under a ESOP plan, but for the business owner, one of the first people you hire is a fiduciary. You pay them up front. Because if you don't pay them up front, it could be construed that they are maybe under your thumb. Mm-hmm. They have to work as a fiduciary for the employees. So you can see it already. You're going to lose a lot of control over your business in the ESOP, right?
Well, and also it depends on the size of the company, because this is an expensive way to do an exit.
Very expensive.
And even more so, the financial standing of the company is very important because you basically have to have a loan against the business, right, to fund the trust. which, one benefit is it doesn't have to be 100% of the shares, right? You can transfer some of it,
and take some of the chips off the table. I mean, the other thing is if you're an S corp, there's potentially very large tax benefits to doing this.
True.
There's different, and again, that gets kind of into the weeds, and we'll talk about that more in another show, I'm sure. But very expensive. It's cumbersome. It's a lot of regulation involved because you got the Department of Labor in there.
Unless your business is over at least $10 million in value, you're probably not going to use this as an option. And
it's probably not a business where you're using the company as your own kind of personal piggy bank, if you will, what we call a lifestyle business. I mean, it would be something that it's a true growth business where you're trying to grow the valuation over a period of time.
Yeah, a lot of details have to be worked out, and it is definitely best if you work from the initial point of very clean financial statements.
Yep, no question.
All right.
Next, guys, we've got sell the business to a third party. And this one, there's even options within this category. So sell the business to a third party. That might be private equity, especially, in recent times, private equity has become a very popular place for money, looking to generate returns outside of the traditional stock market. But you're probably not going to get the highest price.
Yeah, they're going to
selling to a private equity firm. You could also sell to a competitor. They typically will be one of the parties willing to pay top dollar because they can realize the synergies from bringing, your business in-house.
Yeah, they get new clients
back on some of the overhead. Yeah, exactly.
Cut back on overhead now. You've touched on a point that actually a lot of business owners don't like.
Yeah, it's a disadvantage to this method, whether it's private equity or selling to a competitor, is that
absolutely.
You've built this business, you've had employees with you for a long time. You care about them. You want to make sure that they're cared for in the long term after your departure. And there's not really any kind of guarantee that you can have.
Yeah, I mean, the biggest downside to a private equity deal is that you can't really make any guarantees for your employees. Most of the time, they're potentially gonna want you to kind of stay involved in the business to some extent. So if
they want a manager, right?
An immediate exit, that may not be an option. And
exactly, and that's, you might get top dollar through the third party exit, but as you mentioned, Casey, there aren't without trade-offs in that you're going to have to stay around in the business for some period of time. You're probably not going to get all the money up front. There's typically earnouts where you stay on, and there's certain milestones that have to be hit before it triggers the remainder of the payments due to you.
And we're going to talk about this in the next show, which is more valuation focused. But I mean, it's not only about the value, but also about the terms of the deal.
Sure.
Right? So I mean, the terms are very important, if not as important as the value. They're right up there.
Yeah, one of the things that I think we'd be remiss if we didn't talk about. First of all, an owner selling is going to make them lose control. Quite often, people that are business owners, entrepreneurs, like to do it their way. Yep. So first step is mentally get yourself prepared for the fact that you're about to lose control no matter what you do. If you're going to stick around the business in a management capacity under a private equity deal, or even, if you sold to a competitor, which is pretty uncommon that the manager stays, but in both of those situations, you get a new boss. Yeah. Somebody else is going to be calling the shots. Under private equity, you're probably going to see the business get levered up. They're going to borrow a lot of money. They're going to try to make the equity pay for everything, the operations of the business in almost every instance, no matter what. The business has to be healthy so that it can pay out the owner, right?
Absolutely.
But the other thing is you have absolutely no control over what happens to what you consider your employees that will not be post-transaction.
Yeah. I mean, obviously, that's the trade-off between an internal and an external. A lot of times it's about control. Right. You might get a higher price from an external transfer of ownership,
and a lump sum,
and potentially a lump sum. But under an internal transfer, you're going to be able to retain a lot of the control and kind of manage that business, or at least be involved in some of the cash flows from the business potentially, and things like that.
And probably an advisor to that firm as well.
It's still going to be kind of viewed in most of those instances as, if you built the company, you're the entrepreneur, it's going to be your company. I mean, that's your legacy.
Right.
Now, whether you transfer it to another generation or you're selling it to your employees, I mean, they're still going to look at you as the big boss.
And the big boss.
Yeah.
That's true,
That's
and
important.
that can be a little bit emotional too. You somewhat, when you step away from the business, some people just want to be done with it at some point. And trying to make sure that you get a good manager that has plenty of confidence that can take the business into the future, and you want them not to be 100% reliant on you and your opinions. Take the ball and run, guys.
Yep.
100%.
Yeah. All right. So we've wandered down the path a little ways. Nick, you got some more awesome thoughts for us?
You could refinance or recapitalize the business, which is, let's just kind of relate it to what you would do with your home. You're essentially pulling money out of the business, right? If I'm
cash out, refi.
Yeah, exactly, right? If I'm looking to make my exit and I've got all my wealth tied up in the business, let's say the business is worth, I'm just throw it out there, $10 million. Maybe I want to take some money out. And so I take, $2 million and get a loan, right?
Yeah.
Sure.
Essentially loaning against the assets of the company. That's another option.
It's a way for the owner to either diversify or to kind of reinvest those proceeds back into the business and try to grow it.
Yeah,
So
absolutely.
It depends on what your strategy is.
Casey, you said diversify. What do you mean?
Well, and sitting from the financial planning side of the table, diversification is an important aspect. If you've got an owner, in Nick's case, $10 million, that's more than likely that's a big chunk of their net worth. I think most owners, the statistics we read, over 80% of their net worth is in the business.
Yeah.
So, that's a big chunk in one stock. Effectively, it's one company stock that you own, and we would never recommend that you own 100% of your portfolio or 80% of your portfolio in one company. Most business owners are okay with that. They know the risk. They feel like they have control over it, but it's risky. So to be able to diversify out a little bit, take some chips off the table, as we mentioned earlier, and reinvest that money elsewhere for your retirement or whatever your personal situation dictates is important to be able to do that.
Think about it like this too, Casey. Just say, for instance, you got a local home builder, a guy that's got a relatively small business on a grand scale. It just builds homes in a certain geographic location. Mm-hmm. That business is very cyclical no matter what. Sure. In order to diversify, I'll get it out in a minute, you actually might be better off to invest in some things that are consumer staple like businesses that don't
not as
have
highly correlated to your business.
Exactly. Revenues and earnings don't fluctuate near as much during times of stress in an economy.
Well, because that's, again, kind of going back to what we started this whole conversation with. If you get into a period of time with distress, which was the D that I couldn't remember earlier, if we go through another housing crisis and you're that home builder and all your eggs are in that basket, maybe you recover from that. As most business owners we talk to are fairly confident that they can ride through any kind of turmoil in the markets or what have you. But that's going to certainly affect the timing of your exit. And if you're, there's so many baby boomers right now that are business owners looking to retire and exit, wanting to know what their options are. And that's an important reason why, because the timing matters, and valuations are probably higher right now than they've been in a while. And, it might be a good time to diversify if you're looking to exit in the near future.
Yeah. And I think the point here is make sure that you look at that business as one of your assets, not all of your assets.
Exactly.
And I think that's where most business owners, they pour their heart and soul into these businesses. It's real easy to lose sight of the fact that, hey, maybe I should protect myself a little bit.
Yeah, and no doubt.
Well, guys, kind of the last and final option for exit what we're going to discuss is liquidating, right? So let's say
fun usually.
Right.
That's the distress call, right?
And a lot of times you see this where you have a service-based business with mostly the business owner who controls all the relationships, and absent them, there's no real income producing ability of the business. Maybe there's some underlying assets or accounts receivable, things like that, but when that individual wants to exit and they haven't planned, it's kind of like, I'll sell the assets, and that's really what the business is worth.
Yeah. Usually one of the assets, though, is a major intangible, right? And that's going to be your client list. Mm-hmm. It's got value. I mean, you should, at the very root of planning should be, how can I, wrap this in a bundle and sell it to a competitor? That would be the best place for something like that to go, or a young upstart, somebody that wants to get into the business, or maybe even, a a family member as well. So,
Sure.
you know, I think
it's going to be, though, the lowest price you're going of
Absolutely.
all of the strategies. It's going
that's
to be
kind
the
of
lowest.
your last option. You know, if the asset value, if you have an asset intensive business and the value of your assets is worth more than the ability to produce income into the future with those assets, then you're probably better off to do a liquidation. But
right, but don't forget to think about those intangible assets,
no question.
and you probably need an advisor to help you through that kind of conversation. If you need an advisor, where do you find us, Nick?
Henssler.com. You can call us at 770-429-9166, or you can email us at drgene@henssler.com. That's DRGENE @henssler.com. And, you know, as I said in the beginning, guys, there's not a right or a wrong exit strategy. It's really, you know, situational based. But to tie things back to KC, kind of close things out here, part of knowing which strategy is best for you, knowing how much you need in retirement.
yeah,
Right?
And
Because that really dictates what your options are. If you know that, hey, maybe I don't need all the cash up front, or maybe I don't need the absolute highest premium to sustain. I mean, you always want to maximize what you get for your business, right? You worked hard for it. But if I can get more, if I can get $6 million up front as opposed to $8 million over time, and that $6 million fits my financial plan,
Exactly.
and is going to get me through retirement, then there's, you know, things to consider.
doing your personal financial planning is should be done anytime you're thinking about an exit, for sure.
Absolutely. So you're telling me I could take my $500,000 business and sell it for $5 million just because I need that kind of money to retire?
If you find an idiot, yeah.
Thanks for listening to Our 3 Cents. Stick around. We'll talk about that valuation next show.
You just need to commence, gents. Make a great plan, man. A real McCoy, Troy. Our 3 cents for free.
All material presented is from sources believed to be reliable and current, but accuracy cannot be guaranteed. The contents are intended for general information purposes only. Information provided should not be the sole basis in making any decision and is not intended to replace the advice of qualified professionals, such as tax consultants, insurance advisor, or attorney. Although this material is designed to provide accurate and authoritative information with respect to the subject matter, it may not apply in all situations. This is not to be construed as an offer to buy or sell any financial instruments. It is not our intention to state, indicate, or imply in any manner that current or past results are indicative of future profitability or expectations. Portfolio holdings discussed are subject to change. There is no guarantee that in the future these securities will be held in the Henssler accounts. As with all investments, there are associated inherent risks. Please obtain and review all financial material carefully before investing. Henssler is not licensed to offer or sell insurance products. This overview is not to be construed as an offer to purchase any insurance products.